All right, welcome to Talkin' Investing. I'm Tom, and as always, this is not financial advice. Today, I want to talk to you about interest rates. The Federal Reserve is going to raise interest rates tomorrow, so I want to go through what I think they're going to do and what effect it's going to have on the market. And I think some of these numbers that we're going to go through are going to surprise a lot of people. We're just one day away from the Fed doing its thing, so tomorrow afternoon, we will get a rate hike. So if you're new to the channel, please remember to subscribe and hit the notification bell. Also, if everybody could please smash the like button. In addition to that, if you want to help support the channel, there's a button you can press join and you can become a member of the channel. I do make some extra videos for members only, and we do have a live stream every Tuesday. So this afternoon after the market closes, we will have a live stream for members only. Okay, let's take a look at the markets and then I want to talk about interest rates. All right, so at the moment, the markets are down about 1%. S&P's down 1.05, Dow's down 1.1, Nasdaq's down just about 0.7, and the Russell's down 1.5. So we're still in the middle of the trading day. I'm not sure where that's going to end. This basically just gives back the gains that we got yesterday. So we're going a little bit sideways coming into the Fed meeting, which makes sense. So I don't expect a dramatic move in between now and the time the Fed announces tomorrow afternoon at 2 o'clock. Let's talk about what the Fed is going to do, and let's talk about what the market thinks the Fed is going to do, because that is the most important relationship. So by the time we get to a Fed announcement, the market has already priced in an expectation. So the number one thing is, does the Fed do what the market expects they're going to do? If so, then that is a bullish thing for the market. If the Fed does something worse than what the market expects, well, then that is not priced into the market, and then you're likely to have a big downward pressure in the market. So I'm going to talk specific. Tomorrow, we are expecting a 75 basis point rate hike. Earlier this month, before CPI data came out, people were pricing in somewhere between 50 basis points and 75 basis points. The CPI data came out much worse than expected, so immediately it moved up to essentially 100% chance of a 75% rate hike or higher. So you'll see right now it's sitting at 82% 75 basis points and 18% a 100 basis point hike. So if we get a 75% basis hike, it will also depend on what Chairman Powell says after the meeting. Typically, he tries to follow this up with a lot of extra emphasis that he will continue to increase interest rates until we reach our target inflation rate, and the Fed's target rate is 2%, and obviously we were at 8.3% in August. We're nowhere near that. Having said that, in a separate video, I'm going to tell you why I think we're going to get to that faster than everybody thinks. Okay, so a 75 basis point hike tomorrow is built in, so I do believe that if we get that, even if we have a knee-jerk reaction to the downside, because, when Jerome Powell talks, the market tends to go down. But once he's done talking and once it's been digested, I do think we're going to rally off of that. So I'm expecting actually a market rally over the next couple of weeks. On the off chance that they raise 100 basis points, I think that actually would be a bit of a disaster. So although 18% of the market is pricing that in, really there's a very, very strong expectation that's not going to happen. And I'm going to show you just how historic that would be. We're already in a series of rate hikes that is historic. So having already had back-to-back 75 basis point rate hikes, a third 75 basis point rate hike would be still extremely aggressive. A full 100 basis points, in my mind, would point out to the public that the Fed is panicking. And when I show you the history, you're going to see why I think a 100 basis point rate hike is highly, highly unlikely. Okay, so this is an article in Forbes that summarizes all of the rate hikes over the last 30 or 40 years. So I just want to go through and show you guys. This is what we're in the middle of right now. Starting in March, we had a 25 basis point rate hike. Then in May, we got 50. In June, we got 75. That was very high. So this kept creeping up and the expectations kept creeping up. So July, we got another 75. That's back-to-back 75 basis point rate hikes. So this is September. Another 75 would be 3 in a row. This really does not happen. So these are fairly extreme measures as they are right now. So in March of 2020, we had a one-time event, and you'll see on March 3rd, they lowered interest rates 50 basis points, and then it looks like they had an extra meeting and lowered it another 100 basis points. That brought the federal interest rate down to 0, where it stayed for 2 full years. Now, obviously, in that 2 years, the stock market raged, so you can see the Fed obviously couldn't lower rates anymore, although technically they could, but we were already at 0, so they used their entire arsenal in a 2-week period to try and get this thing moving in the right direction. And actually, it kind of worked. Okay, so let's keep going back in time. Okay, prior to that, a year earlier, we had a few 25% basis point reductions. Again, These are reductions in the interest rate. So then we have to go back to 2015 to 2018. This was a long run of Fed rate hikes. This is only one of these that you're going to find. So you'll see at December 2015, the interest rate, the federal funds rate was at 0.25. So it was very close to zero at that point. That's 9 times over the course of a 3-year period where the Fed raised interest rates, and each time it was a quarter of a point. This is more typical of a rate hike environment. And if you remember, that all led up to 2018 where we had a bit of a financial downturn and the market had a downturn. Okay, so then you got to go all the way back to 2008. And you'll see that in 2008, the Fed took quick action again. This was the financial meltdown. So for those of you who were trading in 2008, this was a much bigger pullback in the overall market indexes than we've had so far this year. This was they're calling the Great Recession. This was the financial crisis. Interest rates were at 1.5, so the Fed took quick action between October and December of 2008. They did 50, 100 to get the Fed rate down to 0. So you'll notice anytime there's a bigger number, it's actually moving the Fed rate down to get it at or near 0 to try and boost the economy. We've never seen a series of aggressive rate hikes. So let's keep going back. Okay, so if you go back to September 18th, 2007, now there's a number that I want to show you that's starting to get important. We were at 4.75%. So over the course of less than 1 year, we had all these reductions in interest rates. And again, you'll see when the Fed has to go down, they will run down. They're not afraid of 50, 75, 100 basis points reductions in the interest rates in an effort to stimulate the economy. So we did have a 50 in September of 2007. We had a 75 in March of 2018. Okay, then we have to go back to 2004 through 2006. This is a 3-year period. And again, over the course of 3 years, we were having an economic boom. They're calling it the housing market boom, and that's true. Housing prices spiraled upwards. But you can see the Fed's response to this was to very slowly and methodically raise interest rates over a 3-year period. And they did it 25 basis points at a time. So 0.25 was the biggest rate hike that they had during that entire period of time. That got us all the way up to 5.25%. So you're going to see this is really the highest rate we've had in over 20 years, and this is about how much the U.S. economy can stomach. Somewhere in the 5 to 5.25 is very, very high. Now, historically, if you were to go back to the 90s and the 80s and the 70s, it's a different story. But since then, really, over the last 20 or 25 years, we've pretty much maxed out at 5%, and that's about as high as we can go. It took 17 rate hikes by the Fed over 3 years to get up to this 5.25%. On January 3rd, 2001, just before the dot-com bubble crashed, and then obviously next came 9/11, so that was back-to-back major events. You can see we were all the way up at 6%. That is the last time we've been there. We quickly got down to 5.5 and then 5. So the only time in the last 21 years that we've been over 5% is that one day that I showed you where we were at 5.25. So for the last 20 plus years, that has been the max for the United States federal funds rate. Since 1990, which is 32 years, the only other time we've even had a 75 basis point rate hike was in November of 1994, and that was 1. So that was in the middle of a 50, 50, 75, 50. So you got to go back 27, 28 years. And this still pales in comparison to what they're doing right now. So you'll see over the last 30 years, this is absolutely unprecedented. We've never had the Fed raise rates at this aggressive pace in a 32-year plus period of time. So that's why I strongly believe another 75 basis points is already a historic rate hike change. So 100 basis points to me really would tend to start to indicate a panic. The other thing is, remember, we can only get to about 5 or 5.25. We haven't gone past that in over 20 years. So at some point, they're going to lose their ability to raise interest rates without having very detrimental costs on the other side. So I want to go back to this chart. So this is what the futures are showing for what we think is going to happen tomorrow. So you'll see by next year, February of 2023, there's a 4.5% chance the futures are factoring in that we're going to be at 4.75 to 5.0% federal funds rate. So that is still under that 5.25. 5 to 5.25 is a 0.3% chance all along for the next year and a half. This number never gets above this 5 to 5.25. here. What I'm saying is there's only a few rate hikes left, especially if we're going to do them 75 basis points at a time or 100 basis points at a time. That means we only have 2 or 3 left, and they're not going to be able to do anymore. So for that reason, I believe they're going to stick to the 75 basis points. That's what history really tells us. So 2 scenarios in my opinion. Number 1, we have a 75 basis point hike. And even if we have a knee-jerk reaction that's a little bit to the downside, I think we rally off of that because that has clearly been 100% built in. However, if we do have a 100 basis point hike, then I think you could see some potentially disastrous results in the stock market. So I'm just going to take a quick look. The Dow Jones is only about 3% off of its lows from this summer in June. So the Dow Jones is only 3% away from that right now. If we were to have a 100 basis point rate hike, I think we would take this out and start setting lower lows, and we definitely do not want to do that. This was severe panic when we hit these lows in the summer. So if we take out these lows, I do think then we don't know where the bottom is from there. Okay, this is the Qs, which mirrors the NASDAQ. So from where we are right now to the lows of the summer, there's about 7% room to the downside. So there is a little bit of room, but again, we don't want to take out this summer low. Even if we retest these successfully, that would actually not be a bad thing, but we do not want to take these out and start setting lower lows. And then I'm going to look at the SPY. This mirrors the S&P 500. So this is the broadest measure of the stock market. This is what most people follow. So you can see we're about 5.65% off of the lows from the summer. And again, the summer lows are really the 2021, 2022 lows. So that's the room we have left to the downside. And, you know, over the next 2-3 days, potentially if there's a negative knee-jerk reaction to a 75 basis point hike, it's a potential that we could test these lows. The 2 possibilities the market has priced in are 75 basis points and 100 basis points, which means 100% of people think it's going to be at least 75 basis points. So that is 100% priced in. So again, my hope would be that we get a 75 basis point. That is my hope. That is my expectation, but you never know. So we're going to have to wait until Jerome Powell tells us, and we're going to have to listen to what he has to say at 2 o'clock tomorrow. But to me, that is the single biggest event left in the year to determine what direction the market is going to go in. Okay, so those are my thoughts on the Fed's rate hike. If you made it this far, please remember to subscribe to the channel and smash the like button. Thanks again for watching, and we'll see you in the next video.